Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here's what we're watching this hour. First up, gold's record rally powers higher. We'll look at how you should be incorporating the metal into your portfolio. Plus, Tesla unveils cheaper models, but is it enough to boost sales? We'll discuss. And we'll get a read on the state of coffee competition with the president of Dunkin. All that and more on Market Catalysts. Let's get a check on the major averages and dig into what's going on at the moment. Bit of a mixed picture. The Dow is off by about 0.1%, just under 50 points. The S&P 500 pointing higher by about 0.25%, and the Nasdaq Composite up about 0.5%. So seeing kind of a mixed picture overall. Do want to look at some of the other asset classes here. Looking at what we're seeing yields. Remember, we're going to be getting the Fed minutes, the Federal Reserve minutes this afternoon from the last meeting. There's not a lot of government data out right now. There's no government data out right now. There's other private surveys. So the market kind of paying more attention perhaps to things that it wouldn't normally. So we'll watch bond yields as we go through that. The dollar has been getting a lot of attention for the so-called debasement trade, right? The perception that it is going to continue to be under pressure and that is advantaging other types of assets. But do want to quickly note and pick up on a note that Kevin Gordon made earlier when we spoke to him. So here's a year-to-date chart of the U.S. dollar. And yes, we did see a big pullback earlier in the year, but then it's been kind of steady, kind of sideways. So we haven't seen more downside, at least for the US dollar. Bitcoin, that trade is pausing a little bit today. We are seeing it, of course, up year to date, but today back below 123,000. Gold, though, continuing strong, up above 4,000 and holding at that level. And then just quickly want to dig in the S&P 500 in terms of the sectors that we're seeing energy under pressure there, along with consumer staples. Tech is leading gains again, up by 1.1%, and that's also reflected in the strength of the Nasdaq on a relative basis today. Well, let's talk more about gold because prices there are at records above $4,000 for the first time. Gold's returned more than U.S. and international stocks since 2000, jumping over 50% in 2025 alone. My next guest says gold should be a part of all diversified portfolios. That's Paul Carger, Twin Focus co-founder and managing partner, and he's here with me now. Paul, obviously gold has been getting a lot of attention recently. Do you think there's a case to be made that it should kind of always have a place in portfolios? And what place does it have? What kind of percentage allocation should people think about?
Julie, really great to be here. First, let me say it's a fascinating time to be an investor. At Twin Focus, we've owned gold in our portfolios for the better part of 2 decades. It's always been a 5-ish% position. Over the last few years, given our general outlook, macroeconomic outlook, we've let that position float. So it's up 100% over the last 2 years, up over 50% in this year. We think absolutely you should own gold. And it's not because you can eat it. It's not because it pays a dividend or you can burn it. It's just a great store of value. Listen, gold has had a 2,000-year history of calling bunk on currencies. And we think it's a permanent position in our portfolios.
Do you think that the moment right now in this sort of narrative around the so-called debasement trade, that it is, in your words, calling bunk on the dollar, is that what's really happening?
Everybody's talking about moving away from the dollar, and absolutely that's happening at the margin. Show me another currency that's deep enough to handle the flows, which is what you're seeing go on here with gold. The gold market is $25 trillion, probably about half the size of the U.S. stock market. U.S. stock market, no secret, is up 100% over the last 3 years. Gold is just kind of catching up. We're moving away from the dollar at the margin. Show me another currency that's better. Right now, the world thinks gold is a good place to be.
I also want to ask you about gold. Obviously, people are buying into it through ETFs. They're getting into futures, miners, for example. What about actual physical gold? Is there an argument to be made that you
Absolutely.
should have some gold bars at home or wherever?
We've shied away from owning bars. Bars, when it comes time to sell, are harder to sell because you have to kind of ensure the authenticity of that gold and the purity of the gold. We'd much prefer to own coins. Of course, this raises the question of where you store these coins. They have to be stored somewhere safe. And depending on how much you want to own. I mean, that said, $100,000 of gold is about that much in coins. So I suppose you could have a briefcase you carry around and keep the coins
with the little
with the handcuff
attached to it, like in the movies, maybe. So, okay, so gold. you think you should always have that position there. Digital gold, let's talk about what's going on there, because you talk about gold's long history. Obviously, the history of something like Bitcoin is much shorter, but does it have the potential to have that same staying power?
I think it does. Gold has this bid from global central banks today. And I don't think you have the same bid from Bitcoin or digital currencies yet. So you're going to see a lot more volatility in that. But I think personally, I think that the Bitcoin trade is too large to ignore. Everybody that's been calling bunk on Bitcoin the last decade has been proven wrong. So I wouldn't own it in the same degree that you own gold, but I do think Bitcoin has a place in a diversified portfolio.
Okay, gotcha. So you got your 5% gold, you have something less than that, a Bitcoin. That leaves a lot of white space for other stuff. So how are you thinking about what that mix should look like right now?
It's a great question. One of the issues today in global markets is people are doubting the viability of the 60-40 model. I think you need to own the 60 in equities. Absolutely, you're going to have volatility there, but over the longer term, you want to be leveraged to global growth. So you need to own that 60%. The question is around what do you own in place of this 40? And with all of this currency printing, government bonds, corporate, but we don't think you're being paid a risk premium to own corporate bonds today. So it's about diversifying that 40% that you would normally own in fixed income. We think if you can find it, some high quality real estate makes sense. We do own some fixed income. We do own shorter dated fixed income, municipal bonds, cash for liquidity. We manage ultra high net worth portfolios at Twin Focus. We're really focused on managing clients' risk and liquidity. Mm-hmm. So we do own, fixed income in that capacity. But we think gold, digital assets, commodities, broader based commodities. I think you can't ignore this AI trade, and you look at the ancillary trades on AI, such as copper, other infrastructure plays. I think you should be looking at a broader commodity basket in addition to just gold.
And what about private assets? Because there has been such a push over the past few years to people like your clients to get into private equity, private credit. Do you think it is worth the fees and the relative liquidity that you're giving up to get into those assets?
I think it's got to be buyer beware. It kind of scares me to think about retail being able to buy private equity. Private equity has had a phenomenal run over the last 20 years. Venture has had a phenomenal run over the last 15 years. Is it too late? As you suggest, the fees are very significant. You have limited to no liquidity. You have maybe liquidity in a secondary market, but you're going to pay for that. So I think it's buyer beware. I do think we own billions of dollars worth of private assets, but they were put on in a different environment, and we're very selective of how we're looking at private equity, certainly private credit. I'm very concerned about private credit. I know it's been a hot dot trade the last couple of years, but I think it's very, very much buyer beware there as well.
Let's just linger on that private credit concern for a little bit. There have been some alarm bells raised about it. What is your specific concern, and what could sort of trigger problems there?
As mentioned, I don't think you're being paid a risk premium to be in credit. And at Twin Focus, we try to avoid long lines. We don't want to be in very crowded trades. We take a more of a contrarian view. The risk premium's just not there. And after you pay 2 and 20 to a manager, I really have a tough time justifying that trade.
Paul, good to see you. Thanks so much for coming in. Really appreciate it. Well, the total market capitalization for stablecoins topped $300 billion for the first time in 2025. Stablecoins, one of the fastest growing corners of crypto, and they're quietly reshaping how digital money works. Here with a breakdown of how investors are putting them to work, Yahoo Finance senior markets reporter Ines Ferré. Ines?
Julie, let's talk about stablecoins, because this is a type of digital or cryptocurrency whose value is pegged to an asset. Most often it's pegged to the US dollar. Now, so unlike Bitcoin, for example, or Ethereum, whose prices can swing wildly, stablecoins are backed by reserves such as cash or US short-term treasuries or T-bills to keep their value fixed. The market for stablecoins has exploded as of 2025, like you just said. Some estimates put that at $300 billion. Citi, for example, predicts that a figure could top $1.5 trillion by 2030, or $3.5 trillion in a bull case scenario. So what are they used for exactly? Well, inside the crypto markets, traders use stablecoins to move between volatile assets without cashing out to the bank. They operate 24/7 and settle quickly. They're also used for cross-border payments, digital commerce, trade, and they have the potential to generate yields when they are lent out on exchanges or decentralized finance platforms. And in countries with unstable currencies or where they just don't have easy access to US dollars, they have been a convenient option. A handful of companies dominate this space. The largest by far is Tether, a private company known for its coin USDT. Circle, which went public in June, you'll recall, issues a stablecoin known as USDC. Together, they control more than 80% of the global stablecoin market. The majority of the money that's backing those coins are parked in US Treasury bills. And that is a big reason why the US government is encouraging the use of stablecoins and passed landmark legislation over the summer, creating guardrails for the industry itself. Issuers have become major buyers of short-term government debt, effectively creating new demand for treasuries and extending the reach of the US dollar worldwide. So in short, stablecoins are becoming the bridge between crypto and the dollar and becoming a key component of digital finance. Julie.
Ines, thanks very much. Appreciate it. Coming up, Tesla hoping to boost sales with cheaper versions of its popular models. Is it going to work? We'll talk about it next.
Welcome back to Yahoo Finance. I'm Brig Tapama. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. First up, we have e.l.f. Beauty. Shares of e.l.f. Beauty are moving higher this morning after Morgan Stanley lifted its price target to a street high. Its new price target is now at $170. That's compared to the street average price target of $148. The analyst cited early indicators that the Sephora launch of Hailey Bieber's Rhode brand has clear consumer appeal and is a strategically valuable broadening of e.l.f.'s reach into prestige beauty. The analyst said it's also seeing solid U.S. scanner data. Right now, the stock is sitting around 143. Second up, Warner Brothers Discovery moving lower this morning, even after the financial firm Guggenheim raised its price target on the stock to $22, up from $14. The analyst there cited content-driven top-line strength at both the studios and streaming operations behind the revised outlook. They went on to say that the stock has quite the run this year. In last month alone, it's up nearly 50%. Certainly one to watch as well. And FedEx shares are moving slightly higher this morning after an analyst over at JP Morgan cut its rating on the stock to neutral from underweight. Now, the analyst cited that near-term profitability is under pressure from tariffs, including the removal of that de minimis exemption and muted industrial demand. It also said that its fiscal 2026 earnings outlook could see negative revisions. Keep in mind the stock is down more than 14% year to date. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Rocket Labs, Confluent, and Joby Aviation. First up, Rocket Lab. Those shares are jumping after the company said it signed a contract with IQPS to launch 3 more satellites for the Japanese company. The deal makes Rocket Lab the primary launch provider to deploy the company's commercial Earth imaging constellation. These 3 additional missions bring the total number of upcoming launches for IQPS to 7. The multi-launch contract includes 3 dedicated Electron missions that will launch no earlier than 2026 from Rocket Lab's launch complex in New Zealand. Next, Confluent. Those shares jumping after Reuters reported that the data infrastructure company is exploring a sale after receiving acquisition interest. The company said to be working with an investment bank on the sale process, which is in its early stages. Confluent shares sank in July after second quarter results were underwhelming. Sales attributed to the company's Confluent cloud subscription business, one of its biggest money makers, saw 28% growth in the quarter. That fell below 30% for the first time in company history. The shares up 10% today. And finally, Joby Aviation. Those shares are falling after the electric air taxi company announced a new sizable stock offering. The company said it will sell just above 30 million shares of common stock at an offering price of $16.85. That would result in gross proceeds of about $500 million. They'll be used to help fund certification and manufacturing efforts and to prepare for commercial operations, according to the company. But more shares out there means pressure on the stock. It's down 11%. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Tesla unveiling cheaper versions of its popular Model Y and Model 3. It's part of an effort to boost sales after the federal EV tax credit expiration. Joining me now, Garret Nelson, CFRA analyst. Garret, good to see you. The shares fell yesterday. They're falling a little bit more today. Does this make a difference? Are we going to see any kind of boost to sales from these cheaper models?
Sure. Thanks for having me. We do think it will help them from a sales volume perspective, but only on the margin. It's really inevitable that Tesla is going to experience a pretty significant drop-off in sales volume starting this quarter, starting in Q4. The expiration of the federal EV tax credit is just too great of an event to prevent that, and it's at a time where EV sales are cooling across the board as is, and so this really doesn't help. And I think the announcement was a big disappointment. I think there was speculation that a lot of investors were thinking they might finally unveil the Roadster, which they promised a long time ago, or some other model, which didn't happen.
Something that our autos reporter Prosper Bomani was pointing out earlier is, if you get rid of the tax credit and you have the cheaper base price of these lower price vehicles, is the car still more expensive than it would have been with the tax credit?
Yeah, it's a close call. You really have to do a case study analysis and exactly what you're getting for that money, which is a stripped down version. It's a less expensive, but it's has less features, a lower range. Just not the same type of quality of vehicle that as a standard Tesla vehicle. So it's really a trade-off. And I think the question is, how much demand is there at this point for Tesla vehicles? We know they've been losing market share in the EV market in the US, in Europe, and China so far in 2025. They did have a much better than expected third quarter in terms of deliveries, but still, if you look at their year-to-date market share, it's lower than it was a year ago. And so, the EV sales are cooling. The EV tax credit expiration it isn't going to help. And we think really the smartest thing that Tesla could do would be to introduce a hybrid vehicle, because that is a market that is growing very fast. If you look, hybrid sales in the US were up 37% last year, which compares to only 7% growth for pure battery EVs. So that's, something we think Tesla should think about.
But Garret, let me ask you this. Has Elon Musk lost interest in cars, right? Every time you hear him talk about Tesla, he's pushing the more AI parts of the business, he's pushing robotics, he's pushing robo-taxis. He's not really talking about this core car business, certainly not with the same enthusiasm that he is for the other stuff. And so does that mean Tesla, which has this dominant position in the EV market that's still out there, does that mean they risk losing it to some of the established car companies that are, rolling out more and more competitors?
We don't think he's lost interest in cars. Certainly, there are a lot of synergies between what they're doing in AI and their development of full self-driving, autonomous driving software. So there's still a lot of, it makes a lot of sense to, the AI and the auto business are complementary. But the big problem is that Tesla's vehicle portfolio is pretty stale at this point. It's been 5.5 years since they made first deliveries of the Model Y back in March of 2020. And in that time, they've only had one new vehicle model, which was the Cybertruck, which has turned out to be somewhat of a flop, actually, from a commercial perspective. And so their portfolio is very stale. And in the meantime, you've had all their competitors come out with a variety of new EV models. And so that's why they've lost market share. And so the challenge is really to generate excitement among the consumer base. And, we just still aren't seeing that. The announcement yesterday isn't the kind of announcement that's going to really generate a lot of excitement in our view.
Do you think there's any chance they would come out with a hybrid model? Have you heard anything from folks inside the company that this is something they would even consider?
We haven't heard anything, that they're considering along those lines, but it would be a prudent move in our book. And yeah, they're right. They're focused more on robotics, on AI, on energy storage, and the auto business has kind of taken a back seat in terms of innovation.
And then finally, Garret, you do have a sell equivalent rating on the stock, right? So is it just a matter of waiting for the numbers to get somewhat better, some kind of inflection point here in sales? And what would cause that to happen?
Sure. We just downgraded the stock to a sell a few weeks ago, and it's because after the stock price had essentially doubled from the low in April, and looking at street expectations, we felt that they were too high, that the valuation was frothy, trading at north of 200 times our earnings estimate for next year. And those are the types of conditions which have really preceded sharp sell-offs in the stock over the last several years. The stock has had several peak to trough declines of 40% or more over the last several years. Each time it has recovered from those sell-offs, but typically what happens before those sell-offs is that estimates are too high and the valuation is very stretched. And so we think this is a stock right now that's susceptible to downward revisions in estimates and to multiple contraction. And those are the conditions which are really a setup for a sell-off in the stock.
Interesting. Garret, good to catch up with you. Thank you.
Thank you.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Coffee chains have been under pressure this year with rising commodity prices and a more cautious consumer weighing on sales. But while brands like Starbucks are closing stores across North America, Dunkin just opened its 10,000th U.S. location, and it's announced plans to tap into the lunch rush with a 250-store pilot program to accelerate afternoon sales. Joining us now on this, Scott Murphy, Dunkin president, as well as Yahoo Finance senior reporter Brooke DePalma. Scott, thanks for being here. So 10,000 locations is a lot, and you guys are still growing here. Talk to me about the growth strategy and how you guys are thinking about it, what you're targeting here.
Yeah, sure. Thanks for having me. And 10,000 is a lot, but we still think there's plenty of opportunity for us to grow. We think we can double our footprint in the U.S. While we've got 10,000 restaurants, 9,000 of them are east of the Mississippi River, so we've still got plenty of white space to grow.
So that doubling the number would lead you to 20,000 locations. That would actually be more than what Starbucks has right now. They have about 18,000 locations. As you think about that expansion plan, you're getting into the Dutch Bros territory, the Black Rock coffee bar territory, and even, Starbucks and McDonald's even expanding. So how do you size up against this competition as you expand out west?
Yeah, I think we're actually very well positioned. Obviously, we're a market leader in lots of categories. We sell more hot drip coffee, iced coffee, and obviously donuts than anyone else in the country. And when I think about that afternoon segment, the iced beverages, the ones that the young generation is starting to drink, we are market leaders. We invented iced coffee, and we've got those bright, colorful, Instagrammable drinks that everyone loves. And we just launched a test to reclaim the afternoon. And we've got 250 stores that are doing this new program. New uniforms, bright new colors, all beverages across the menu boards, new music, just a whole new vibe for Dunkin' in the afternoon. And we're really excited, seeing some great results in the afternoon.
Scott, what is the key indicator that this 250 pilot will then lead to all locations? What are you seeing in the early innings here? I'll admit, I was in Colorado over the weekend and I did have a Dutch Bros Rebel drink, and they seem like they have it down pat. There's so many zero sugar options, and there's a multitude of different options to pick from. So how do you compete in that?
Yeah, I think we compete in it quite well. So we've got all those same options. We've got great drinks. They're colorful. They've got fully customized options. We've got sort of 0-calorie options. Stay tuned. We've got all the proteins. We've got the cold foams. We've got all of those great drinks. And we do it at the speed of Dunkin'. So I think all our drive-thrus and really our speed and our value. And I think that's the differentiator that Dunkin' brings.
Well, let's dig into the value proposition a little bit, Scott, because obviously we know that consumers are challenged right now. They're challenged in part because of rising prices for everything. So how do you keep it value, and still maintain your margins and your franchisees' margins in this environment?
Yeah, it's tough. I feel bad for the consumer right now with everything that's going on. But a lot of things we do is we use our app, our rewards program, to really give targeted offers to our most loyal consumers. And we give it in ways that make sense. We do bundled offers, we do repeat offers, and we give them the offers that matter most to them. And we use the targeted offers and the one-to-one to do efficient marketing. So we find savings that way to make sure that we keep margins right for franchisees.
And again, to dig into the margin question a little bit, we know coffee prices have been going up, and of course you have tariffs that are affecting that as well. But it's not just for coffee prices; it's for other input costs too. So, what kinds of levers are you all pulling to try to manage some of those costs?
Yeah, tariffs are tough. Sometimes they can come out of anywhere, but we monitor those things very proactively. We've got a very great supply chain that's looking around the corner and watching for these things. But honestly, the most important thing for us is quality. We haven't changed our recipe on original blend coffee in 75 years, and our QA team makes sure that we deliver that perfect cup of coffee every single day. We sell billions of cups. But we use all sorts of tools to make sure that we're managing costs. We've got a pricing tool, a proprietary one for franchisees to help them price appropriately to manage their margins and make sure that we're setting prices appropriately for them with suggested recommendations.
Scott, right now we're in this environment where I think every single retail and CPG executive and beyond has told me that consumers are very choiceful. How would you categorize the consumer right now and the demands that they have for maybe this non-essential good, their quick stop in the morning?
Yeah, it's a great question. And the consumer is very choiceful. And I'll say, especially in times of recession or potential recession, one of the first things people do is they cut back in their morning trip. And, the industry has certainly seen that in the breakfast day part. But I got to be honest, we haven't seen that in our business because I think after a couple days of not getting your morning fuel with Dunkin', you actually start to cut back in other areas. And we've seen nice growth in the morning day part with Dunkin', and people have come back to get their morning fuel to get their day going.
So they're stopping for a bit and then they're returning because it's a necessity for them. I like that, Scott. I do also want to quick on something. Reward members also, as you noted before, are really a growth lever for Dunkin'. And so much so that consumers are always talking about any changes that you make to the rewards app. Can you walk me through the recent changes that you guys have made and maybe how it's different than what it was prior to?
Yeah, we made some recent changes to the program because honestly, we had to. Obviously, with tariffs and rising costs, we hadn't changed the programs and the redemption rates in years. So it was time to do that. And we just had to adjust for a couple of categories. And we adjusted when the points expire. They give a full year now for points to expire from purchase, which is really the industry standard. So we've done that now.
And Scott, finally, I want to ask, as you embark on further expansion, and note that it is a rate lowering environment, that the Fed, of course, has begun to cut interest rates. So, because when you expand, you need franchisees to do that expansion, right? You need them to open stores. So how much does that rate cutting tailwind help with your quest and for your franchisees to get financing?
Yeah, it helps tremendously. And honestly, I was looking at the numbers this morning. Last week, we opened a new Dunkin', both new and remodeled in the new image, one every 2 hours last week. So our franchisees are well capitalized, taking advantage of those rates and opening a new version of Dunkin' every couple hours. So come out and see us because the new Dunkin's there.
Scott, thanks so much for joining us. And Brooke, thanks as well.
Thank you.
All your markets action coming up. Stay tuned. You're watching Market Catalysts.
The luxury housing market is cooling. Redfin data shows luxury home prices are still rising, up 4% year over year, but sales have fallen to their lowest August level in more than a decade. For more, we're bringing in now Chen Zhao, head of economic research at Redfin. Chen, it's good to see you. So let's start big picture on this luxury housing market. You have some stats, Chen. Prices up, sales down, inventories elevated. What explains this trend?
Yeah, I think what we're seeing right now in the luxury housing market is very similar to what we've seen in the rest of the housing market the last few years, which is that it's just really frozen. There doesn't seem to be a lot of demand. Like you said, there is more inventory than a year ago, but there isn't as much inventory as there is in the rest of the market. And sales are very low. They're really at historic lows right now, even compared to the rest of the, very sluggish housing market. So it seems that what is happening is that these buyers are really pulling back, and whether that's because of economic uncertainty or it's something else, I think that those are things that we can talk about, but it feels like there's not a lot of demand right now.
And when we talk about the luxury housing market, Chen, how do you all define that?
We define it as the top 5% in each market. So one thing that you might naturally think about is that a luxury house in St. Louis is not really going to be the same as a luxury home in Miami or in New York City, but we define it as the top of those specific markets.
It's interesting, Chen, because when I might have assumed if we're talking about this, luxury housing market, with the stock market doing what it's doing, Chen, just record, a lot of folks focused on that kind of house, focused on that kind of market would have been feeling relatively pretty good.
Yeah, I hear what you're saying, but at the same time, I think a lot of buyers are looking at the luxury market right now, and they're seeing that the housing market as a whole, prices are getting very soft. In a lot of the places where you think about where luxury homes are, like in South Florida or in LA, these are some of the places where prices are the softest. So I think some people are worried about catching a falling knife. They're saying, well, if prices are coming down, or price growth is really coming down, maybe there's going to be more of that in the future, and I should just wait. I think folks are also thinking about, where is the economy headed over the next 6 months or a year, because we did have a lot of policy volatility earlier this year, and we haven't really seen that completely play through yet.
We've been talking there nationally, Chen. What are some regional differences you would point out? Maybe, pockets of strength or weakness?
Yeah, so right now, in terms of prices, we're seeing that prices are the highest actually in West Palm Beach. They're up about 15% year over year, but very close to that, is Tampa, and their prices are actually down 5.5% year over year. And then if you're looking at sales, we're seeing that sales are down about 19% in Miami. But on the flip side, if you look at Indianapolis, their home sales are up about 19%. And I think that's a testament to sort of the relative affordability in a place like the Midwest.
Does what happens in the luxury market, Chen, does that matter for the broader U.S. housing market? Are the two correlated in any way?
They are very correlated. You do see that, what's happening in the luxury market is similar to what's happening in the rest of the housing market. There are very stark differences, obviously, between the two markets. However, obviously, luxury buyers are much less affected by mortgage rates. They're more likely to be all cash buyers. A lot of times, people who are, buying in the luxury market also have more optionality. So, for example, if they don't like, where prices are going, sellers don't have to sell. They might just choose to hold on because they have the financial flexibility to do that. They could rent it out if they like what's going on in the rental market, for example. And a lot of times people who are looking at the middle of the market, they just don't have that same financial flexibility.
How much do rate cut expectations matter for the luxury market?
I think they still do matter because, like I said, when we're thinking about luxury, we're thinking about the top 5% in each market. So obviously for, a luxury apartment in Miami or in New York, a lot of those buyers are paying all cash. They're not really thinking about mortgage rates. But a luxury buyer in other parts of the country are, a lot of times they are still financing. So they are still thinking about where are mortgage rates. They're thinking about what the Fed is doing. And this is another instance where I think people are worried about catching that falling knife because because they're seeing that the Fed is cutting now, and they're thinking, well, the Fed is going to cut more, so maybe rates will fall more, even though, we know that those price cuts are already priced into mortgage rates today. But they might also be thinking, hey, look, if the economy weakens more, we could actually get even more price cuts from the Fed, and that means mortgage rates will go down. You're
an economist, Jen, so I'm just curious. You look at your crystal ball. How many cuts are you expecting over the next 12 months?
Wow. Yeah. I think that, the market expectation is 2 cuts right now. I think that is a good baseline expectation. But it really all depends on this economic data. It's too bad we couldn't get that jobs report last Friday, because I do think that what we're seeing in the jobs report, especially the unemployment rate, that's really what is going to be driving how many rate cuts we see.
So the 30-year fix, Chen, Mortgage News Daily says 6.38. What do you think? Where are we 12 months from now?
I think 12 months from now, we're probably pretty flat to where we are right now. But there is a lot of uncertainty. Like I said, it really just depends on what happens to the labor market. If that labor market starts to really weaken, if it seems like we might be on the cusp of a recession, we could see much significantly lower mortgage rates. But if we're seeing what we're seeing currently, which is that the economy is weakening, but it's still holding on, and there's still that threat that inflation could tick up still from, higher tariffs. That means that, mortgage rates 6 months from now, probably also 6.38.
Chen, always good to see and to have you on the show. Thank you.
All right. Thanks so much for having me.
There are 457 leveraged ETFs that trade in the U.S., compared with a total of more than 4,300 ETFs overall. That's according to ETF.com. And leveraged ETFs have a total of about $160 billion in assets. So what are leveraged exchange-traded funds? The SEC first allowed them in 2006. They're designed to boost the returns of a specific index or asset that they track. So while a traditional ETF tracks securities on a 1-to-1 basis, leveraged ETFs typically aim for a 2-to-1 or 3-to-1 ratio. Leveraged funds use various investment strategies, such as the use of swaps, futures contracts, and other types of derivatives to accomplish that goal. Due to their compounding effect, investors can enjoy higher returns in a very short period of time, but leveraged ETFs come with significant risk, as they also magnify losses. Plus, they tend to be more costly, and they can be less tax efficient, as they can generate capital gains throughout the use of swaps and other derivatives. We expect at least one more interest rate cut before the end of the year, and as rates fall, many investors are seeking ETFs that capitalize on looser monetary policy. We're joined by Will Rind, Granite Shares founder and CEO. Will, it's good to see you. So we were just sort of explaining the concept of leveraged ETFs. You all have a pretty broad suite of different kinds of leveraged ETFs, and something that is in, I guess, the same family, but not quite a leveraged ETF, is your yield boost product, which is linked to this idea of rates coming down. So can you, first of all, just explain the product to us?
Yeah, thanks, first of all, for having me, Julie. Good to see you again. So yield boost ETFs are options-based income ETFs. So they're designed to generate high income on a weekly basis. And effectively how they do that is they sell options on underlying assets. In our case, these are leveraged ETFs, and that generates a high weekly distribution for investors.
And have you seen an uptick in demand because of the rate cutting cycle?
Yeah, it's really 2 things at work here. So on the one hand, it's rate cuts or the anticipation of rate cuts and people wanting to generate higher yields. And the other one is that, as the market ticks higher and higher, it's people effectively converting growth into income. So maybe thinking that instead of continuing to buy the market, I'll buy a high income fund whereby I'm not speculating on the upside of the market, but I'm changing or converting that growth into income today. And I think those are really the 2 most pervasive trends that we see.
Will, as we just talked about, when you're talking about a leveraged product or something tied to a leveraged product, there is an increased risk. So what do people need to know? This is, as an old friend of mine who covered the ETF industry used to say, you have sort of like green light, yellow light, red light on ETF products in terms of their sophistication, and leverage probably all goes into that red light bucket, right? So What do people need to know before they get into these kinds of products?
I mean, this is a classic, trade-off, as with most investments in terms of risk and reward. So with yield boost funds, you'll see yields, annualized yields or distributions, in some cases as high as 170, 180%. And so for anybody that is looking at that, they rightly will ask themselves the question, how's that possible to generate that kind of yield? And the answer is in the strategy that we provide, which is selling options on underlying leveraged ETFs that themselves are highly volatile. So you were able to generate high yields, but of course, with that comes a higher element of risk. In other words, there's more volatility in a yield boost ETF than there is in something like a US Treasury. And then in order to try and combat some of that volatility, we also buy or use bought put options to offer some downside protection as well for investors to try and insulate that. But like I said, the basic trade-off here again is like classic risk and reward. Higher yields, but higher risk.
Will, while I have you, you guys have a gold ETF too. That is one of your, if not your biggest products. So I imagine you're pretty busy with that one at the moment as well. What kind of activity have you seen in there, and what does it tell you about how sustainable this rally is going to be?
Yeah, I mean, look, unbelievable. Myself, I'm a big fan of gold, as you know, have been for many years now. And even I've been surprised by the move past 4,000. I thought we would get there, but I didn't think actually we'd get there this year. So the velocity of that rally in gold has been something astonishing. Even more so, perhaps, and this is probably something that investors don't know much about, is the rally in platinum. We have a platinum ETF, PLTM, which has outperformed gold. And I think what you're seeing here is just a broader allocation to real assets or hard assets. So gold leading the way very much so, but followed by other precious metals as well, such as platinum.
Will, great to see you. Thanks for joining us.
Thank you.
Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, we'll get a preview on what to expect for third quarter earnings season. Plus, we honed in on the state of buy now, pay later as analysts kick off coverage of Klarna. And we'll look at the sticking points in healthcare negotiations as the government shutdown continues. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets and take a look at the major averages. Now all three in the green. We had been seeing the Dow show some weakness, but now it's recovered, up almost 100 points, about 0.2%. The S&P 500 up double that, 0.4%, and the Nasdaq leading gains once again, up 0.6%. Expectations for third quarter earnings season somewhat muted. Bloomberg estimating just over 7% earnings growth for the S&P 500. FactSet estimates 8% growth. Now, if either is correct, that would make this the slowest quarter of growth in 2 years. Joining me now, Cindy Beaulieu, Cunning CIO North America, and Jim Misturzo, Research Affiliate CIO of Multi-Asset Strategies. First of all, just to level set, to be clear, it's not going to be 7% or 8%. Companies beat every single time. We know it's going to be more than that by some amount, right? So Cindy, I guess I would just start by asking you, how do you think this earnings season is going to compare in terms of whether it's slowing, whether it's the same, whether it is accelerating? What are we going to hear?
Sure, and thank you for having me, Julie. So, as we look at the third quarter earnings possibilities, it's certainly been an interesting year-to-date period that we've had. The economy has grown more rapidly in the second quarter, and it appears, at least what we know about the third quarter, is showing pretty good pace as well. But the other thing we know is that we haven't really seen the impacts of tariffs yet in terms of flowing through inflation, which means those prices are ending up somewhere, and likely some companies have been challenged in having to manage through those, and they've seen some margin compression. And so we may see a slightly softer earnings period for the third quarter, but nothing that's alarming. I mean, even if you think about 7 or 8% type earnings growth, yes, it's a deceleration from where we have been, but not something alarming that should get people more concerned about the prospects for the future. It might just be that, we have seen plenty of momentum on the Mag 7. It's been a place where a lot of the earnings growth has come from, and that's starting to slow a little bit as that technology transitions. And we should expect that there will be some ebbs and flows of earnings momentum out of those types of companies. But as you look at the broader 493, there's been some left behind in all of this, and they're going to start to catch some attention as well. You look at what we saw for the difference between earnings of the Mag 7 and the 493 for the second quarter. It was a decent difference, but it wasn't quite as alarming as people thought. So I guess to circle all the way around to that 7 or 8% number seems reasonable, and that's not a number that should be concerning. It is just a slowing of the momentum that we have seen over the last couple of years, as you mentioned.
Jim, let's dig a little bit more into the large cap tech stocks, which have been powering not just the stock momentum, but the earnings growth as well, accounting for a lot of that growth. What can we expect there, especially now at a time when we're getting questions about the circularity of the AI trade?
Thanks for having me. I mean, I think it's an interesting thing, as we were just saying. A lot of the earnings growth has been within the tech sector, and that is starting to spread out a little bit, but still materially, concentrated. As we look at it, the U.S. market continues to be overvalued, and it's been overvalued for a long time. So slowing earnings 7-8%, agree, that's not necessarily, troubling, but we're starting to get the feeling that investors are looking at lower rates and a monetary policy fix that's going to sort of keep these things going. And from our perspective, that might be a little bit misguided. There's a lot of other things going on in the economy that don't necessarily lead us to, recession, that sort of talk, but there's definitely slowing. There's increases in, late payments on autos and those sorts of things. So, earnings seem fine, but there are definitely cracks beyond that.
Well, but just to take the other side of that, Jim, I mean, can't the AI trade just keep, even before we were in this rate cutting cycle, even before we really necessarily anticipated when it was going to happen, the AI trade was sort of pulling everything along, and the earnings growth is there too. It's not as though these are profitless gains. So yes, the PE is going up, but it's going up by a lot less than it would be if they weren't making more money. So I guess how long can that be the case? Can that sort of pull everything else along?
Right, that's the great point. Valuations are important, but they're not a great timing signal. Things can stay expensive, they can continue to get more expensive, and to your point, maybe at a slower rate, but that can last a long time. So it's a question of when, it's really hard to tell. What are the things that are out there that could impact? Well, we know we've got at some point, there's an electricity issue that won't allow us to power all AI tools forever. I also tend to think that regulation, which hasn't really played a big part in AI, will at some point, maybe not in this administration, maybe after the midterms, we don't know. That's another big thing. What we tell our investors is, and we tend to look at the Shiller Cape as our metric. The U.S. market is trading at about 40. Its all-time high is 44 in 2000. Sure, we can go back to 44, no doubt, but there are a lot of other options on the table, other investments. Emerging markets up 30% this year. No one's really talking about that anymore. We were talking about that in the first quarter when the U.S. was down and EM was up. Everyone stopped talking about that. The focus is on tech stocks, AI, gold, platinum, those sorts of things. So we've really been reinforcing the EM trade with our investors.
And Sydney, what about you? As you look at U.S. versus outside of the U.S., and it's not just EM, by the way, international broadly has been continuing to kind of hold up here. Is that, especially going into earnings, is that a place that you want to be allocating?
That's an interesting question because to the point Jim was just making, there's been tremendous returns outside of the U.S. to to date, and can that really continue? You know, the Eurozone is certainly facing its own challenges, and interestingly, many of them are political and fiscal. And so does that at some point start to kind of dim the lights on Eurozone opportunities? Does the UK find its way out of its own challenges that are also fiscal? You know, the US has not been alone in the fiscal problems that are emerging here. They're showing up in other places too, Japan as well, political questions, and what does that mean for the path of rates in Japan? So while there have been great returns outside of the US this year, it's also interesting to note in the last couple of months, we've seen a resurgence of the US dollar, and the returns on that have improved. So while the first quarter and into the second quarter was a lot about, is US exceptionalism dead? I think what the world is finding out is there was a great alternative for a little bit, but remember, diversification is really critical when you're talking about managing portfolios.
Yeah, and Cindy, it's interesting that you bring up that point about the dollar, because right now we're seeing things like Bitcoin taking a pause today, but still trajectory has been up. Gold has been up on part about this narrative about the lower dollar, but the dollar, to your point, has stabilized. But I'm curious, do you want to allocate in those directions also?
You know, those are also interesting areas. We have some questions about the long-term validity of Bitcoin. You know, we are primarily fixed income investors here, and so we look at assets and whether or not things like crypto are truly an asset that belongs in where we manage a lot of insurance portfolios. So we have a little bit of a different take there. Gold is certainly interesting. You know, typically that is an inflation hedge. In this environment, when you look at it alongside crypto, you have to wonder, is that not just generally a fiat currency hedge? Is it just more about the concerns more broadly globally of fiat currencies and the path for them going forward for some of the challenges I just mentioned? So gold is certainly on an interesting path, but let's not forget also the US, we think, has an inflation problem still, and that is why we are concerned about the direction the Fed may be going here. If they lower rates too quickly or too aggressively, we do think that that really can stoke inflation. There is still demand in this economy, as we have seen by the consumption of consumers, business fixed investment coming back. So if you think about that demand and a lower rate trajectory from the Fed, that combination can be pretty detrimental for the path forward for inflation. And that is really where our focus is. And perhaps gold is catching some of that as a bid as well.
Jim, what do you think about the inflation issue, especially given that we might not get the CPI report next week that we were supposed to get if the government remains shut?
I agree with what Cindy just said. We are definitely continue to be concerned about inflation, which is sticky. The last inflation print, to your point, 2.9% core inflation remaining sticky. They haven't been able to get it lower, and now the Fed has decided to pivot more towards the labor market, as we've seen softening there, and begin to lower rates. So, a key point, and my favorite word came up a few minutes ago, which was diversification, and that's what we were telling all of our investors as well. Especially in this environment, we need to be diversified. The Fed, with its dual mandate, is going to have to decide whether the labor market or inflation is the thing that they want to focus on. Usually it's one or the other, or one is more, say red at any particular time. Right now, they're both flashing definitely yellow to red, and they're going to have to decide. So investors need to be prepared for everything, and the easiest way to do that is to have a fully diversified portfolio.
Cindy, Jim, thank you so much. Appreciate it. Coming up, Klarna is getting its first ratings after going public. What analysts are saying about the appetite for buy now, pay later. We'll be right back. Bank of America initiating coverage of Klarna with a buy rating, saying there's more headroom to run for the buy now, pay later company. Joining me now, Mihir Bhatia, Bank of America payments analyst. Mihir, thanks for joining us. It's good to see you. So obviously there's been a lot of growth in the buy now, pay later space, and Klarna's much awaited IPO finally happening. Why do you think that it is so well positioned? Is it a scale issue more than anything else?
Yes. Firstly, thanks for having me, Julie. Great to be here. Yeah, I think you're absolutely right. I think it's a scale. It's a combination of things that is driving, we think, upside for Klarna and why Klarna is such an interesting investment. Scale is certainly a big part of it, right? Klarna is the largest BNPL player in the world, has over 100 million consumers on the platform, over 700,000 merchants on the platform, and those numbers are increasing. So as a result, we think scale is a big driver of it. In addition to that, you also just have a secular tailwind in the US in particular, where Klarna and BNPL was a little slower to come in compared to the rest of the world, and you're starting to see some nice growth here in the US too.
Now, one of the persistent concerns over BNPL is, sort of defaults, what happens if the U.S. economy, or for that matter, other places where it has exposure geographically, whether there's some weakening and then the defaults go up. How well do you think Klarna is managing that risk?
Yeah, I think, Klarna has done a pretty good job managing that risk historically. And as they get more data and more consumers and more merchants on the network, more transactions, they are able to use tools to refine their models. The other thing to keep in mind with BNPL, particularly at Klarna, is about 80% of the volume, 75-80% of the volume is pay in for or short-term loans. Right? These are inherently much easier to underwrite than an open-ended credit card loan. A lot of these are you're doing transaction level underwriting, you're underwriting a particular purchase and for a very short amount of time. So that helps with the credit metrics and keeping credit in check. And what tends to happen is, unemployment and some of these changes take longer to flow through the system and really impact consumer finances. In a lot of those cases, by the time that happens, the BNPL loan is paid off already. So that's a big part of it, what helps the BNPL companies keep credit in check.
The shares have not done a heck of a lot, Mihir, since their IPO. The IPO price was at 40. They're trading really just above 41 right now. What do you think has kind of held it back, and what could sort of unlock better performance here?
Yeah, I think it's always hard to say in terms of really short term what has been holding shares up or down a little bit. There's certainly been some macro noise. We've certainly seen in the last couple of weeks across the sector, particular concerns around low income consumers in particular. And those are, when you think of the US market in particular, which is a high growth market for Klarna, that is the population that tends to use BNPL a little bit more than overall. So I think that is certainly a factor that has held it back. I think the other thing it's important to take a step back and look at the big picture, right? At the end, what is going to make the stock move higher is the network going to grow? Are more consumers going to transact on Klarna? We think the answer to that is yes, as they add merchants, as they add consumers, and as BNPL as a category continues to benefit from growth in the US. And that's what, over the longer term, we think that's the more important metric to look at is the network growing. One bit of data that we got recently from Klarna was they've added 1 million Klarna cards in 11 weeks in the US. That just shows you the vibrancy of the network and demand for consumer resonance with the network.
Mihir, there has been, not just for Klarna, but in general for buy now, pay later, there have been some critics who say it encourages irresponsible spending. There was just a story in the New York Times yesterday that looked at some examples of that. And there has been some talk from Washington about perhaps regulating the industry differently. Do you see that as a risk?
It is certainly a risk, right? I mean, I think that there's two ways to think about that issue. One is absolutely it encourages consumers to spend, but arguably credit cards do that too, and we've had credit cards for a long time. That said, I think, again, it's important to think about how the product is actually used by consumers. A lot of consumers use it really as a debit replacement, particularly in America. It's much more of a debit replacement than a credit card, replacement. It's also the way consumers and the BNPL companies engage with the consumers is you're underwriting each transaction. So it is not in the company's interest to have consumers become over leveraged. Most of these companies don't charge interest, don't charge fees on the typical BNPL pay in for transaction. So that's certainly a factor. Now, regulation, on the other hand, that is definitely a risk, right? This has been a pretty light touch regulatory environment for these companies while they have been over the last few years. And if you start to see more regulation, that would absolutely be a risk for the companies in terms of both higher costs, but also just in terms of disclosure, growth, because usually with regulation, you have to make additional disclosures, put some steps in that can make the sale process a little bit more cumbersome.
Mihir, thanks so much for joining us. Appreciate it.
Thank you for having me.
Much more markets action coming up, including some trending tickers. You are watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session. Now we're seeing all three major indices reverse into the green. We did see the NASDAQ and S&P 500 start stronger, but the Dow came under some pressure at the open, and now we are seeing some renewed momentum. The Dow up about 0.3%, but the NASDAQ yet again leading the charge there as this AI tech rally really does continue. It's up nearly 0.8% 2 hours into today's trading session, and we continue to see that upward momentum for the NASDAQ. The S&P 500 also holding on to this upward momentum, up about 0.5%, and this really has had a strong rally, especially from those April lows, up more than 14% now year to date, nearly 15%, as we're getting more and more calls from the street for the S&P 500 year-end target to increase. And I also want to take a look, because as we see these equity markets marching higher, we also are seeing some unusualness in terms of both gold and Bitcoin also rising at the same time. Now, keep in mind, gold is traditionally a safe haven asset for investors. They typically seek it out in times of turmoil or uncertainty, and that's certainly what we saw earlier this year, especially around those April lows. But now we've also seen this upward momentum continue. It crossed now $4,000 per an ounce, and it's now up more than 50% year to date. On the back end of that, we've also seen silver futures rally as well. Year to date, silver futures are up more than 64%, and that's sitting around $48 per an ounce. Now, at the same exact time, we also are seeing strong momentum in Bitcoin. Year to date, Bitcoin has had quite the run. It is up nearly 30%, and earlier this month, it did cross that $125,000 threshold. It's up more than 9% this month. And now there's some speculation on the street that we're seeing this debasement trade, and investors really seeking out these alternative assets like Bitcoin and gold. So we'll certainly be keeping a watch on that, especially throughout October, which is typically already a strong month for Bitcoin. But I also want to take a look at the NASDAQ. So we did mention at the top that is leading the charge and the momentum this morning. And NVIDIA is seeing gains this morning, up nearly 2%. And that's after NVIDIA announced a plan to invest about $200 billion as part of an equity deal with Elon Musk's xAI. That's his artificial intelligence company. We are seeing Tesla, that's another one of Elon Musk's company, just really not really moving too much this morning, roughly flat, up about 0.4% after it did see some downward momentum this morning. But other stocks leading the charge here, we do have Micron moving higher, up nearly 5%. Also AMD moving higher, up nearly 6%. And we really are seeing this AI tech rally continue this morning as really investors hope that we continue to lead more record highs. Once again, though, all three major indices in the green 2 hours into today's trading session. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout the session.
Now time for some of today's trending tickers. We're watching Dell, Cisco, and Disney. First up, Dell shares extending gains after the company roughly doubled its growth estimates for sales and profit for the next 2 years. Dell also said demand for artificial intelligence products will extend those higher projections at least through the 2030 fiscal year. A bunch of price target increases followed that. TD Cowen raising its price target to $150, Citi to $175, and Melius lifted its target to $200 a share. As you see, it's trading under $165 right now. Next up is Cisco unveiling a new chip and networking system to challenge Broadcom in connecting AI data. The new products allow for faster transfers of data across long-haul optic cables. The new products meant to link up far-flung data centers and help them work together to develop artificial intelligence models. Previous versions of the Cisco product could work over similar distances, but they didn't transfer enough data to be useful for things like AI training. And finally, Disney. The company hiking ticket prices across the board for its Disney World and Disneyland parks in the U.S. The steepest increases hitting Disneyland's top-tier tickets, those purchased on the busiest, highest demand days. They jumped to a record $224 per adult, $224. That's Disneyland in California. And that represents a 126% spike over the past decade. Disney officials told MickeyVisit.com, which first reported this, that the hikes reflect rising labor costs and ongoing park expansions, pointing out that cast member wages have more than doubled since 2015. While the cheapest ticket has increased only $5 in that time. Now, together, these changes mean a family of four could now pay nearly $900 for a single busy day visit to Disneyland before things like food, souvenirs, parking. At the same time, Disney is offering lodging and dining discounts for some multi-day stays. Also, off-peak ticket prices have risen about par with inflation, so I guess it pays to go in the off-season. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise, to navigate the best moves for your portfolio. I'm here now with David Wagner, Aptus Capital Advisors, Head of Equity and Portfolio Manager. David, it's great to see you here. Let's start with the one you like, and that would be Progressive. Now, this one, haven't done a whole lot this year. It's actually basically flat. It's up like 2%. The street is fairly divided on what to do with this thing. You say it's a buy. Let's go through the reasons why, David. The first reason you say you're committing capital here, attractive valuation.
Yeah, Josh. One, I don't just like this stock. I absolutely love this stock right now.
That's all what we like, the enthusiasm.
Bring it. Yes. All right, I got a trivia question for you.
Yeah.
In the last 10 years, all right, Progressive is the second best performing stock in the S&P 100. Who's the first?
Wow, give it to me.
NVIDIA. It's going to be NVIDIA, but no one would guess that.
Yeah.
And yet you've actually had earnings per share growth almost to the same extent from a growth level perspective over those 10 years out of Progressive like you have with NVIDIA.
Mm-hmm.
Yet to your point, the stock is only up 2% year to date. Mm-hmm. We're getting some type of digestion right now. I think there's some overblown fears in this market that have priced into this attractive valuation. I mean, there's no point why this stock should not trade at a, let's just say, inequality or in parity with the S&P 500 at 22 times. But right now, it's trading at 13 times forward earnings. That's a 34% discount to the S&P 500. And we haven't seen this much of a valuation disparity relative to the benchmark, the S&P 500, actually since the peak of the dot-com crisis. Yet all the fundamentals still remain very strong. Actually, I think growth is some of the best that we've seen over the last 10 years, what we witnessed over the last, call it, 2 years. And I sincerely believe that Wall Street, their earnings expectations are actually way too low right now. So I think it's a screaming buy.
All right, so the first reason, it looks like a good deal. The second reason, you were hinting at strong growth fundamentals intact.
Yeah, I think we're going to pair this alongside the valuation argument here. Obviously, Progressive, it's a financial, it's an insurance company, but in my mind, it's more of a staple. Okay, staples are obviously sometimes the most expensive house in probably the most expensive neighborhood outside of tech when it comes to valuation. But I see Progressive as more of a staple because you have to have car insurance. Yet you're getting growth rates, EPS growth rate expectations of, let's say, 7, 8, 9% over the next few years, which is 3 times greater the growth rate of most staple companies right now. And not only that, like the model that Progressive has, like they've just been so intuitive really since the early 1990s on their underwriting process where they kind of have 2 different levers where they can pull. When a lot of people are going out there looking for market share gains, the company can kind of harvest some profitability and not, demote their underwriting abilities. And when other companies are going out there and not growing and trying to harvest some margins, this company is going to absolutely go out there and try to grow because they have the most intuitive from a technological aspect underwriting process versus all of their peers.
All right, final reason you say buy this one, variable dividend.
Josh, in the United States, we don't have many variable dividend policy names. Obviously, energy has kind of thrown their hat into the ring here lately, based, doing variable dividends off of free cash flow. It's more of a European style capital allocation policy, but I love it. They have a very, de minimis, call it 16 basis point base rate when it comes to their dividend, very static, don't grow it. And then based off their free cash flow and operating profitability, they're going to yield you, no pun intended, some type of variable dividend at the end of the year. And given the strength in earnings that we've had, they actually report earnings on a monthly basis, which is very weird. Donald Trump would hate that now that he's trying to go to every 6 months, give or take. But we could see almost a $10 variable dividend hitting the market, which the market should absolutely love. And I think that's probably the catalyst here to get this valuation back into historical ranges. The last thing I would say here too, this is a really easy model to kind of fundamentally take out on a time series analysis. I think if you go out and look out far into the future into 2030, I think this company can give you about $50 billion in shareholder yield, whether it's through buybacks, the static dividend, the base dividend, or the variable dividend. And to put that into context, they're planning to give it about $6 billion this year here in 2025. So that alone right there, it's a pretty good CAGR.
All right, so you've made your case, David, convincingly, all right? Before viewers, though, they pile in, what are the risks you need to think about?
The risks are well known, in my opinion. And it's obviously why we've gotten this valuation degradation in the stock over, to your point, actually the last 6, 7, 8 months when the stock's only up 2%. It's all coming back to policy growth. I just mentioned that the stock kind of has two different levers to pull. You can kind of harvest some profitability when everyone else is trying to go out there and extend too far to reach for growth, or they can harvest on their overall margins or grow their share policy count if everyone else is kind of sitting back due to whatever restrictions that they have. So the market is pricing in. A lot of their peers are going to kind of stretch for new share policy growth here in the near term, let's call it next year or 18 months. And in this market, when it's all about growth, I'm not saying, growth tilt versus value tilt, it's all about earnings per share growth and free cash flow growth, is kind of the main factor contributing to returns right now. If that starts low, or the expectation of it for Progressive, the stock's kind of been hit. I just don't see that coming to fruition. They've been growing their policy count at a very healthy clip, some of the best clips that we've seen in years, which I think should bring that valuation back into parity.
All right, so you like Progressive. Let's turn to one you don't like so much. You would avoid Intel, David, all right? Why would you avoid Intel? Let's go over some reasons there. Insufficient third-party customers.
They've lacked just so much innovation, Josh. And I think when it comes to this name, I actually don't think you can short this name right now. I don't think. I think
it's up about 80% this year now.
Who would have thought a year ago that Intel, Josh, go back to 2021, 2022, the biggest pair trade out there was all right, let's go long AMD and, support that long with proceeds from shorting Intel. And that's been a heck of a trade for quite so long. So this is definitely flying in the face, this 80% return year to date to many of the market pundits out there. But given the headline risk, and mostly when people talk about headline risk, it tends to be in a negative connotation. Here would be a positive connotation. Obviously, they have their hand in now with NVIDIA and obviously the U.S. government. So I wouldn't want to short this name by any amounts. I think that it could keep some momentum. But if I own shares at this current valuation 25 times forward, I just would be probably trimming my shares.
All right. So let me go. One reason, insufficient third-party customers. A second reason, you'd be avoiding this one here. No innovation, you say, David?
None.
Yeah.
I can't think of the most recent innovation that they've had. I mean, they've kicked the can down the road, kind of like the U.S. government and their debt for quite some time, that they've not been able to grow any of their third-party users. I think for you to get behind this name, you got to get those third-party users on board, new innovations. You have to bring the product to market. You have to get that pushed out into the market in an efficient manner. None of that has happened whatsoever. I mean, you and me both know that kind of the lead time for new innovation of chips, we've moved past Murphy's Law, no doubt there. We used to have new chips basically every 3 years. Now we've learned from, NVIDIA and Blackwell and obviously their new cadence of chips. The cycle's every 1 year right now. And with NVIDIA, if you can't get new technology out or anything along those lines over the span of a few years, and you've been able to do it for the last 3 years, it's tough for me to get behind this name.
All right, final reason you say avoid uncertainty over Intel's fabs.
Even the CEO has uncertainty over Intel's fabs. I'm from Cincinnati, Ohio. Obviously, they had the foundry conversation up in Columbus, Ohio. Obviously, that's on the back burner. But I think the announcement that they had with Jensen, all of last week with a partnership with NVIDIA, no one talked about the foundry side of the business. It's almost like you could push the foundry side of the business out from, or at least sell it from Intel, just because they are so far behind. I mean, if they get any type of demand there, it's just because TSMC, Taiwan Semiconductor, is fully supplied out, given the amount of demand there. They kind of get the tertiary amount of demand out there in the market on the foundry side of things. So I think that could get sold off, but you're not getting any type of growth there whatsoever right now.
Finally, quickly here, David, given all that, how could you be wrong on Intel?
If they come out with some type of new technology, I think that would fly in the face of what any analyst would expect. Because obviously they got some capital from the US government, obviously from NVIDIA too, but that $10 billion that's coming in from the US government, that's not enough to change things whatsoever in my mind. So they're just so far behind the curve. And me and you both know when it comes to technology, there's some type of economies of scale there. Once you start to fall back at any point in time, you're kind of just left in the dust. I mean, there's a lot of companies being left in the dust right now. I think Intel was left in the dust 3-4 years ago.
Stocks have been rocketing higher since the post-Liberation Day April 8th lows. And over these 6 months, tech is surging. Chip stocks are flying, and meme stocks are once again lighting up quote screens and Reddit boards. But how long can this retail investor-led buying spree last? That's what we're asking on today's Stocks in Translation. Let's dive in. Here's the quick scoreboard. Since stocks put in that capitulation low 6 months ago, the Dow is up 24%, while the NASDAQ is up twice that, nearly 50%. But check out the chip stocks, up 80%, and the disruptors in Cathie Wood's ARK Innovation Fund, left for dead in the wake of the 2022 bear market, it has more than doubled, up 120%. These incredible returns are suggesting that the AI trade is back and retail traders are once again asserting. But let's dig in some more. This bar chart right here from Morgan Stanley shows estimated retail demand going back a decade. The year-to-date total for 2025 is already $630 billion, more than all of 2021. And if the pace continues into year-end, that will mean $800 billion in retail buying, which is what the final bar on the right is showing. Importantly, Morgan Stanley says this is not a repeat of 2021 because first, households are not at peak stock exposure, at least by historical standards. Second, borrowing against stocks is smaller relative to the size of the market. And third, a lot of the money this year went into broad funds like ETFs, not just one-off hype names. So we're probably not at froth levels just yet. But let's talk some individual names. Over the last 6 months, it's fitting that Robinhood, the poster child for meme activity, is up an eye-watering 320+%. Then there's Coinbase, capitalizing on the crypto craze, up nearly 150%, followed by Palantir and Carvana, each of which has more than doubled. And while the names are familiar, the drivers are different than back in 2021. Back then, stimulus checks and pandemic boredom, they were the big drivers. Today, it's more AI news flow, chip cycles, cloud spending, and dreams of more Fed rate cuts. If the sprint slows, this is probably where you're going to see it first. So, how do we tell if things are cooling? You want to watch for a few simple things. First, a lot of retail buying is done through options, especially all-in call options. So watch for this activity dying down. Then watch price action in leading indexes and stocks. If the fresh record highs start drying up and leaders start pulling back, that's a tell. You could even watch the intraday activity of high-interest retail names, the so-called meme stocks. Are big pops on the open? Are they seeing more buying interest? Or are the so-called gaps getting sold? This is where classic candlestick charts can help identify weakness. And finally, Morgan Stanley argues that steady paychecks are a key to retail buying these days. So if the labor market continues to cool down and firings pick up, that means the rocket fuel is drying up. So here's what to watch next. We got to keep an eye on the jobs data as the fuel gauge. But the shutdown has literally shut down the biggest reports. As long as it goes on, we need to keep an eye on private reports like those from ADP and Challenger. The Chicago Fed also recently put together a great tool that estimates the official labor market numbers from the BLS. Then watch the AI headlines that move real money, especially as earnings season evolves in the second half of October. What's going on with the cloud spend, new chip launches, big orders, and data center builds. And then there's been a lot of big AI partnerships and mergers announced. Any new export or regulatory curveballs could throw cold water on this trend. And finally, this is perfect. As of October 8th, Roundhill is relaunching their meme stock ETF with the ticker MEME. That's your daily price action gauge in one of the most speculative corners in the market. Morgan Stanley says we're in the midst of the third retail wave that's emerged over the last year. If the flow stays strong, the sprint can keep going, but watch out when those simple tells start flashing red. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more Market Catalyst up next.
The government shutdown is in its 8th day with no end in sight, primarily due to a standoff over a renewal of expanded tax credits for the roughly 22 million affordable health care enrollees. The current set of credits is set to expire at the end of the year. So what happens if they do expire and they're not renewed? Let's bring in Dr. Ezekiel Emanuel, University of Pennsylvania Vice Provost for Global Initiatives and former member of the Biden Transition COVID Task Force. And of course, Zeke, you were also instrumental in the creation of ACA in the first place and the input into that legislation. Thanks so much for being here.
Great to be with you.
So this is what the Democrats have put at the centerpiece of what they would like to change as part of these government shutdown negotiations. And I think we're trying to wrap our head around exactly what effect this would have on Americans who were insured as part of ACA. So can you walk us through that?
Yes. During COVID, the government expanded the subsidies to people buying individual insurance in the ACA marketplaces because we wanted more people to have insurance so that they would actually go to the doctor if they had COVID or they had some of the symptoms. One of the big consequences is premiums came down and more people flooded into the market. We have over 24 million people in the ACA marketplaces. Now, with the threat of taking away those extra subsidies and this is very important, a sort of a projected 18% increase in the costs and premiums anyway, partially because of rising healthcare inflation in the healthcare marketplace, but also because of uncertainty around Trump and Trump policies. Those premiums are going to go up extraordinarily high. But if the extended subsidies aren't renewed, you're going to have basically a doubling of the premium. You're going to go from about an average of $888 for a family to over $1,900 for a family. And the consequence is predictable. People who calculate, well, I can't afford $1,900, I don't have serious health problems, I'm not going to renew. And that leads to what in the healthcare field we call adverse selection. Sicker patients are going to be buying ACA coverage. That itself will drive up prices, drive healthier patients out, and will have a very terrible cost spiral. That will be very bad for the country, lots more uninsured people. It'll also be very bad for people who need health insurance because the price will go up and up and up.
Zeke, wasn't this tax credit, though, as you pointed out, came in force during the COVID era, was designed to be temporary, right? And to get more people, as you said, to go to the doctor when we were seeing sort of the height of COVID. So why is that still necessary if that was the original intent?
Why is health insurance necessary? Because it's important for people to get health care. And we now know, because of studies by the Treasury Department and many scholars, that actually having health insurance is associated with lower mortality and better health, less stress, and other advantages. So we know, actually, that if we take away health insurance from people by not subsidizing their purchase, people will die. It's estimated more than 50,000 people between the cuts to Medicaid and the cuts to the Affordable Care Act are going to die as a result of loss of insurance. That's why we have insurance in the first place. Now, we did learn that the mandate has nothing to do with people buying insurance. Right? We thought when we were passing the Affordable Care Act, you had to require people or financially penalize them if they didn't buy insurance. But in fact, what it is it's just a matter of price. If you subsidize these very expensive plans, you can actually get people want them and they will enroll. And we've seen this. We've, again, had a record 24 million people. Our uninsured rate is now, has been at 8% because of these extra subsidies. It's not universal coverage yet, but we're getting much closer because of these added subsidies. So the bottom line is you cut the extra subsidies, the premiums will go up tremendously, fewer people will get insurance, and more people will die as a result. And by the way, here is one of the supreme ironies of this situation. The places with the most, the states and jurisdictions with the most people in the individual market, they're all red. They're all Republican states. 4 out of 5 states with the most people in the individual market. Georgia, North Carolina, Texas, Florida, all voted for Donald Trump.
Right.
6 out of 10 congressional districts that have the most people in the exchanges voted for Trump. The irony of the ACA, which people don't appreciate, is it was Democrats passing legislation that helped Republicans.
Well, Zeke, I'm curious to pick up on something else you said, which you talked about that maybe the mandates were a mistake. It had to be sort of subsidized and
No,
priced.
it wasn't a mistake. They're not necessary.
Okay.
The real factor is.
Where I was going was this. As the ACA is currently constructed, are there any other tweaks that you think should be made to make it more effective?
Yes, I do think one of the things is to advertise so people know about it, know how much subsidy they can get. California, in their exchange, actually spends I think it's 1/3 of all their administrative money on advertising. Because one of the things the advertising does is it gets to people who are generally healthy, working, can't really focus on getting insurance, and gets them to buy insurance. And when you have more healthy people in the marketplace, you actually lower the premium price. And that's a logic that I think most Republicans and many Democrats don't understand. If we got universal coverage, the people who would get coverage tend to be people who are healthier, and therefore the average costs come down.